Welcome to Markets Now. I'm Michelle Rook along with Brad Kooima with Kooima Varilek, and we are seeing some mixed trade in the grains this morning. The row crop sector setting back. Wheat is to the plus side over in the livestock futures. We've got cattle higher and the hogs are lower. And Brad, let's start off talking about this cattle market. Of course, we scored some new contract highs in live cattle futures yesterday. And then we saw a bit of a pullback or some profit taking, maybe even some hedge pressure, not sure which. But we're back up today. So I was worried about a reversal. And so where do we need to close today from a technical standpoint, first off?
Okay, let's start there with the technical side of the market. Thanks for having me on, Michelle, of course. Now I need to glance up at my chart, so I apologize for my lack of... so you got June cattle is where the open interest is now. Outside day reversal down yesterday. Higher high,
Right.
lower low. Increase in the open interest and pretty good volume. All the things that are qualifiers, so important area, heavy volume and open interest change. Those are the two, one and two. And then the third one is follow through. If you want to believe in it, that's the simple definition of a technical reversal. So if we don't follow through, in other words, if we would, to me, I think we'd be fine if we'd close back above 160, 130, 40 on June cattle. I mean, higher close would take it away. To really, really make you feel good, you'd want to probably see if we could close above the high close so far, which is 162.12, which is 50 cents away. So to me, if we're higher today, I think it erases most of the negative action yesterday. And for me, I thought the action yesterday has the same hook or the same thread that it does today. And that thread is feeder cattle. And that's because of what's going on with grains. Yesterday, with that, the break started in the feeders with the higher grain, which was triggered by the announcement from OPEC. Now this morning, you've got at least in this part of the Corn Belt, and that's what the market, I think, is trading. You've got a warmer, drier, more moderate, more favorable to getting planting started forecast here in the, the medium term, the 3 to 6 and the 6 to 10 day weather looks a little more favorable for getting started in the field. And I think that's what's putting pressure on the corn, and that's helped sponsor the reaction on the feeder cattle. And if you want to talk just feeders, like August feeders here have just about are back to the highs of the move again. So nice way to kind of erase the worries of yesterday. However, at 8:45, we got a long way to go, right?
That's right. Let's talk about last week. Part of this was pushed by some higher prices in the cash market, prices we haven't seen since I think January of 2015. What do you expect for cash this week?
I certainly don't know why anyone would take lower money. I think that the feedlot operators got a little bit more bow in his neck, and some of that's because of the lack of supply in the north. You and I have on this program have talked about that. I thought that there was that people didn't understand that because of the weather and the high cost of gain, we pulled our yearlings ahead. And we postponed the calves being able to be fat here in April. I'm a feeder. Okay, I know what this weather has done to rate of gain and cost of gain. The supply of cattle across the north here for the next 30 to 45 days is less than what I think the trade anticipated. And in fact, it is as tight here, the show list here, and I do monitor that very, very carefully. Is the tightest it's been in 3 years. If you're looking for some high quality cattle, they're going to be hard to find here. And I think the north is going to continue to carry a significant premium to the south because of quality and because of lack of supply. And the other thing I'd like to mention is we negotiate for cattle up here. How about that? Anybody that is going to try to tell me that doesn't make a difference is going to have a hard time convincing me, because I am convinced. Look at the number of negotiated trade last week, a huge spike. At the same time, we put $5, $6, $7 on cash. It's not a coincidence.
No doubt. And you've been running premium to the south for a while here now, haven't you?
Very characteristic of a bull market. I always wondered, back in the day, why did people care so much about the north? Well, it's because our supply is not static like the supply of cattle in the south is. It's, if you think about it, oversimplify it maybe, but because of the environment, they're able to calve year round. Here it's a very seasonal deal. Some of the guys calve in the fall, but the vast majority, 75-80% of them calve sometime in the spring. So there is a real seasonality, and it's that shift in the supply of that 25% of the supply of the cattle in the north that's enough to make the difference. Like we've said before, it's a fine line between too many and not enough, and that's why the supply of cattle in the north is very critical to the overall direction of the cattle market.
You bet. Well, and as you said, hopefully we'll hold on to these early gains that we have as we go through the day. Hog market started off with some pressure again. We still see some pressure in the front end of the board as you and I speak here, but the perplexing part is that funds are record short and they keep pushing the short side of this market.
Perplexing. That is a great word.
That's not the word you were going to use, I'm sure. Well,
yours is PG, which is a good thing. Hogs have been an enigma for me, very difficult to trade. What as a trader, you sit here and you go, well, either you think it's going up or down, right? I mean, who thinks it's going to go sideways? So when you sit here like me and you go like, well, really, 92-cent June hogs? Do I think hogs are going to be 92 cents in June? I do not. Now, does that mean it works to buy them? So then you try that.
Are we trading the fundamentals, Brad, or not?
I don't think so at all. I think you're trading money flow, to use one of your words. I think the funds got this thing by the throat. The small speculator says this looks too cheap. He tries to buy it, gets run in, starts all over again. Remember, these algorithms and these funds, they don't know the difference between a barrel and a gilt. It's strictly a trend following, self-fulfilling type of a deal. Now, I used to have a saying taped to my phone back when we used not headset phones, that there's a paddle big enough to fit everybody's rear end.
Behind, yeah.
Yep. And I would like to think that there's a paddle big enough to fit these funds that are short the hogs too. But in the short run, ample supply, soft cash. What is the cash? There's very few of them traded anymore. Usually as you move toward May, this thing rallies. Let's hope it does. It's been a tough market to trade.
All right. Since you brought up the word money flow, let's talk about that in terms of the grain sector. We had bullish reports on Friday for old crop corn and soybeans and for new crop soybeans. Of course, we traded through some of that yesterday. You suggest that we've had a change in the weather as part of the pressure, but we've had a good run here now and retracement levels have been hit. So some of this could just be some profit taking and a little hedge pressure too, couldn't it? Or some farmer selling?
Yes, and probably rightfully so, in my opinion. The tendency to rally from someplace, get this spring rally from March 1 to May 1, somewhere in that window where the market frets about too hot, too wet, too cold, too dry, whatever. Very seasonally normal. As a broker, you sit here and go like, okay, guys, so we missed this thing. So let's see if we don't get a little bounce just before we go to plant. And you get a nice bounce here. And sometimes we still forget to, think about what that should do for us from a marketing standpoint. Unfortunately, I'm Debbie Downer here. I'm not really very friendly to the grains, except in the old crop, especially the old crop corn. I don't see really how they're going to break that market very far, given the tightness of the basis and the tightness of supply. However, there's to me an analog deal here where it just feels like 2013. I know feelings. I don't know. You shouldn't trade feelings, but okay. So 12, we had a drought. During the winter of 12 and the spring of 13, we switched from the La Nina, switched it, right? It got wet. We had a late spring in April. Very, very similar. I've looked at the snowpack. You can actually get a chart on that if you can believe it. And what did we do? We had a late spring. We had a big acreage number on March 31. Does that sound familiar? Same thing we had this year. And then it rained and we raised a big crop and we took the market lower. To me, these prices are reflective of areas that if I was a producer, I would be sensitive to trying to do something. Now, if you want to have upside potential, let's at least do something in terms of with options or something like that you do. But weather can flip in a moment. We usually get it planted. We've had a couple of bad years weather-wise. The odds would favor, it is the Corn Belt. That's why we do plant. That usually the weather is more favorable than it's been the last 2 years. So
yeah. And old crop doesn't necessarily need to pull the new crop along. You can just you can accomplish that through spreads, right? And the cash basis levels.
Exactly. Very well said. You'll accomplish it two ways. The spread, and mostly because of the regional imbalance of supply, they'll take care of it with basis. To follow through with that 13 analogy, the July D's corn spread that year went to like $1.80 over. I mean, so
Wow.
it can really, really change in a hurry. But yeah, talking weather markets pretty early this year, aren't we? But
Yeah,
that's
we
the way to
are.
do it.
Okay. Thanks for joining us, Brad Kooima with Kooima Varilek, and that's markets now.